Good afternoon, everyone, and welcome to another installment of Investing with IBD podcast. It's Justin Nielsen, your host, and let me go ahead and just address the elephant in the room here. My hand is a little busted. I did have surgery on Friday. Arusha Pires, who joins us every week, he's on the show too. He's an O'Neill portfolio manager, O'Neill Global Advisors portfolio manager. He had surgery on Friday as well. Arusha and I are close. We have surgeries together. He got it on the gums. I got on the hand. You put us together and we make almost a full person. So how are you recovering, Arusha?
I'm recovering. I'm pretty good. I mean, apparently the market has injured both of us over
Right,
the last few
Yeah.
weeks here.
We've taken our licks, and that's okay. And you know what? Might as well introduce our guest because just out of solidarity, I thought it was really nice that Jeffrey Hirsch, editor of the Stock Traders Almanac, he decided to get a cut on his finger. So he's probably going to be lifting his finger for most of the time. Which finger, though? We want to make sure that you're not,
It's totally unnecessary. It's the one that I think somebody's missing that plays guitar.
Okay. Okay. Very good. So Jeffrey Hirsch, of course, we usually have him at the beginning of the year because we go over his January trifecta. He uses so much of the Stock Traders Almanac data that's been collected over, gosh, how many decades now, Jeff?
It spans 7 decades.
7 decades, okay.
To the present, but its 57th edition is coming out this fall.
Of course, the Stock Traders Almanac started by Jeffrey's father, Yale, very esteemed in the trading community for starting that, and the data that he collected, which is really useful for kind of giving a backdrop of what precedent says, what you can expect, what's normal, what's all these things. So again, a great piece of information that a lot of traders use, comes out every year. You can get it on Amazon, or of course you can go to the website Stock Traders Almanac and get it. You get a subscription with that too when you get it from the website.
Yes, right? You do.
Yeah. So
and all the updates throughout the year.
Probably the better way to go. But let's go ahead, and we're doing a kind of special mid-year update. So let's kind of go back to January, because there's 3 things that you look at for the trifecta. And when we met with you last, we didn't have the data yet for all 3 things. Right. So maybe you can start there.
Well, January January's barometer was the main thing that Yale created in 1972. As January goes, so goes the year. All the things that happened in January, including Congress convening, sort of came into being with the 20th Amendment to the Constitution that moved Inauguration Day and new Congress to January, et cetera, and so forth. But January has taken it, on the chin a bit recent years. And we were looking at some other of our indicators. Santa Claus Rally is another one that Yale invented, as Santa Claus should fail to call. Bears may come to Broad and Wall. That's the title of one of the pages in the book. He defined that back in 72 as well. Last 5 days of the year, first 2 of the new year. Then there's the old first 5 days early warning system that's been around forever, something traders were tracking since, probably the 20s, 30s, whatever. And we looked at combining these 3 things. So you've got the end of December, right after the new year, the first 5 days, that first week of the year, and then the whole month. And what we found was, and I think we're looking at that table here, is that when you hit the trifecta here, and this is going to be a new page in the Stock Traders Almanac, the upcoming edition for 24. When you hit this trifecta, it's a really bullish indication for the year. And you can see that, out of the 31 times in the past, we've been up 28 years at 17.5%. Then we just take out the January gains themselves just to look at the next 11 months. 27 of the 31, it's like an 85% accuracy ratio. It's like 12% change there. And, when we were talking, I think we had the 2 of them in, or I forget exactly.
Yeah, I think close. I think we had the first 2.
We discussed my forecast. Last year we were pretty bearish and got bullish in October with the seasonals and the 4-year cycle aligning. And we were coming into 2023 pretty bullish. We had our base case scenario, typical pre-election year results. And then best case scenario was like 15 to 20% general for the indexes over the year. And then after we spoke, we hit the trifecta, and we had several of our own, subscriber webinars, which is something we do monthly, and other, presentations I made. And one of the things I kept saying, and some of my people, picked up on it, was my biggest fear this year was that I wasn't bullish enough, and lo and behold, here we are in early August. We'll talk about that in a second. Things are rolling over a bit, which is okay and expected, but what was the NDX, the NASDAQ 100 was up 46% at the high. Right. I mean, and that was that sweet spot. We spoke about the 3-quarter combo from the fourth quarter of the midterm year, first 2 quarters of the pre-election year. NASDAQ averages 29%, Dow and S&P about 20%. NASDAQ didn't hit its low until the closing low till the end of 22, but made up for it pretty much in the first 2 quarters. So we hit the sweet spot, we hit the trifecta, and here we are entering the summer doldrums.
Yeah. So now, one thing I do want to address, though, and again, you kind of laid this out. I think one of the first pieces of data that you shared was back-to-back negative years. That's not something that you see very frequently. Where we were in the election cycle. So there were a number of data points that you brought out, but let's talk a little bit about March, because March we have this event. We've got Silicon Valley and we've got all these things. Does that throw you when you're like, oh, things are going, and we had a strong January, a little bit weak in February, and then March it was like this, whoa, what's going on? Does that throw things off for you?
I mean, you're constantly adjusting your outlooks. I mean, everyone thinks you pick the S&P is going to be here at the end of the year. That's why I can't change. I mean, even my friend Craig Sandler at Piper, he just upped his year-end stuff, and he's a consummate technician and a great guy. But we shifted back a little bit from best case. After the trifecta hit, we're slipping towards best case, and then a little back to base case, and then we looked at the 10-year, and we did a pretty much pro and con analysis of what would need to go wrong for us for the market to really break down, and what would need to go right for it to really explode. And the 10-year, held, didn't get anywhere near the high, kept going down, and we broke through some technical resistance areas as we got past March. But admittedly, that sell-off in March was worrisome. We said, let's be patient, let's be cautious, but it was definitely sort of dialed back the expectation a little bit, when we were going through that until we got past it.
Yeah, and that's where you almost saw that shift, right? I think it was like middle of March, where all of a sudden the market just realized that, hey, you know what? The safety stocks are the NASDAQ 100, right? Let's just throw all our money in Apple and Amazon, right?
Ironically, that's the Ides of March. Aside from, Caesar and that whole history, March is volatile. It's like comes in like a lion, out like a lamb. And that middle of March is a real bear, pun intended, because of the end of the first quarter, triple witching coming on. I mean, we saw things get hammered there in previous years. We had big selling at the end of March, so some end of quarter mean hits there. So on top of the event that was happening, it was also a historical seasonal time for danger time.
Yeah. And I think you mentioned that when you were on the podcast too, that you were kind of a little, and this was way before anything came out, but you were like, hey, March is kind of, the time that I look for after that. Of course, we got this nice, tight action in April, and then things really started to pick up in May. And now let's talk a little bit about where we're at now. And you've got another table that you provided here for us, called the Hot July Markets and Late Summer Autumn Buys. So walk us through what we're seeing here on this table.
Yeah, again, this is something that Yale noticed years ago, and that we've honed and tweaked. And basically, you've got the summer rally hype that gets bandied about when things quiet down in the summer, and it's brokers and institutions are looking to keep clients in the market and busy, so they talk about that summer rally, which is the weakest of them all. But when you see the market really strong in July, which is I'm showing the Dow here, and we've got the tables and numbers on the S&P and NASDAQ as well. It's pretty similar. It's not necessarily to show here, but it's on our website, for subscribers and stuff. The numbers here, you're seeing any gains in July of over 3% for the Dow results in a lower, better purchase price later in the year, usually in the September-October timeframe. On average, you'll see some very mild numbers here. It's not always a huge buy, but at least you get another opportunity at those levels. There's a couple of really fractional declines. But last year was case in point. Year before that was case in point, where you had a pretty sizable decline. And if you remember last year, we used our aggregate cycle pattern, which we'll see in another chart before for the midterm year. Everyone was pretty keen on that summer rally last year, which is sort of revolves around. There's another little mid-year NASDAQ rally. We call it the Christmas in July, which is end of June, middle of July, and everyone was pretty keyed up. All the bulls came out, and we're like, whoa, hold on a second. This thing looks like it's going to settle back down in September, October. And then when we got the low in September, October, like, oh, it wasn't a capitulation enough, and everything didn't bottom at the same time. It's like, well, now we know that doesn't have to happen. But
well,
again,
Jeff, in the middle of July, when things are rocketing, just like this July, no one wants to listen to those things. We're all like, let's go. And
well, when you write a book every year that has to look out at least 18 months, or you kind of have to keep perspective of things that may happen. It's not always 100%. Okay?
Yeah,
nothing ever is. But I wrote my outlook for the 24 Almanac about 6 weeks ago. It's published June 20 something date, and I'm already talking about December 24. And you have to
amazing. Wow.
Keep these things in mind. But yeah, no one wanted to believe it, and here we are. Beginning of August, you got the typical August chart queued up too, I think, which which dovetails with this here, because you look at seasonal patterns and you have the average month that we have in the back of the book, with the typical month, but then each month has its own personality, and August in particular has a very weak beginning, and it's because Justin's going to Hawaii. Jeff's going to Hilton Head. People do things. I just spoke with my friend Bob Pisani about some things, and he was just like, "It's really quiet here. There's no,
That's funny.
People are doing things. People are away. My partner's taking off. He's doing some stuff out of the office today. That's what happens. That's what creates these summer doldrums. So
we're getting surgeries.
Etc. So forth, or just being outside in the nice weather now that some of the heat's broken here on the East Coast. It's still summer though. Mm-hmm. So this is just a combination of the all year performance for the last 21 years, and then just pre-election years going back to 1950. And pre-election years are a little bit worse. I would venture to guess, or to say that weakness comes from a reaction to the outsized strength that happens earlier in the pre-election year.
Okay.
Mm-hmm. Yeah. So it basically needs to digest.
Take a break, profit taking.
Right.
I'm going away. Let's close positions. Got to hit.
So we're right here right now, right? August 9th, right here. So we're just
those are trading days, Arusha. So just be careful.
Oh, okay.
Yeah. So a little bit earlier than that, because
got it. Okay.
But you notice the dotted lines of the pre-election year are lower than the solid lines of all years. So there's a little bias towards a weaker August in the pre-election year.
I like it. Yeah.
And any
September's no prize either. What's that?
Say that one more time.
September is no prize either.
Okay, right. But it looks like there's a tendency to be a little bit stronger at the end of August, but then you're saying that kind of really doesn't last into September.
Yeah.
And then talk to us a little bit about because you do have the different coloration for the Dow, the NASDAQ, the S&P 500, the Russell. Do you see any differentiation between, oh, there's a shift sometimes to different areas of the market, or is it just kind of, they're all kind of doing the same thing?
Look at the black line of the Russell.
Uh-huh.
And if you look at, there's a page in the Almanac that compares the Russell 1000 to Russell 2000. There's a little pre-Labor Day pop in the small caps.
Okay.
That seasonally happens there.
Mm-hmm.
So if anything, if there's something to trade there or look at in the short term, it might be the IWMs or the small caps.
Mm-hmm. And just Arusha, do you have your Market Smith up? Maybe we could just take a quick look at the Market Smith, kind of wrap up this market segment by just noting that, in terms of our IBD take, we've got a number of distribution days that we've hit on the NASDAQ. We had that distribution cluster that we mentioned a couple weeks ago. So all of this is really kind of dovetailing exactly with what Jeff is saying. We're using different indicators that are kind of happening day by day, but it's kind of fitting the model that Jeff's laid out here. So pretty nice
Justin,
confirmation.
And one of the keys that we definitely want to emphasize is it's underneath the 21 day.
Yes.
And and you can see on the NASDAQ right here, whenever the NASDAQ's above the 21 day, that's when our type of stocks work even better and they trend much better. But over the last couple of weeks, it's been pretty tough, and that's when it broke the 21 days. So you definitely want to, focus on that to know where your sweet spot is for our type of stocks.
Yeah. And one of the things we talk about sometimes on this show is the power trend. The power trend is still intact, but it's under pressure, and that's because we did get that distribution cluster. That puts it into an under pressure situation. The other thing that can put the power trend into under pressure is when we get below the 50-day moving average line, a break of that, which we're right at that line now. So we'll see if we get some support here. But Jeff, let's go ahead and we'll take a break right now. And when we come back, we're going to have you chat a little bit about the 4-year cycle and where we're at specifically in that. So stay tuned. We'll be right back.
Trading Apple? Sometimes you get the bear. Sometimes it gets you. Single stock daily leveraged and inverse ETFs from Direction. Before investing, carefully consider a fund's objectives, risks, charges, and expenses contained in the prospectus at Direction.com. Read carefully.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host here. I'm raising my hand because I have a question throughout the whole thing, but Jeff is answering all the questions. Of course, we have O'Neill, portfolio manager, O'Neill Global Advisors portfolio manager, Arusha Peiris, who joins us every week, and our special guest this week, returning to the show with a special mid-year edition, is Jeffrey Hirsch from the Stock Traders Almanac. So Jeffrey, let's go ahead and get into the presidential cycle. So a lot of times you're kind of breaking down a cycle that happens based on the election cycle, for the presidential, so of course you got year 1, 2, 3, 4, there's a 4-year cycle. And then of course, do you break it down from, okay, this is a incumbent cycle versus a first term and so on. You've got data on pretty much everything, right?
We do. And sometimes you break it down too much and you end up with like 3, examples.
Right. Yes. A sample size of.
So you have to be careful with that. However, I learned from Larry Williams that sometimes an analog of 1 is just as valuable if it tracks well. So it doesn't always have to be, a massive amount of data points to get a good average, because then you're just averaging things out. So it depends upon your usage, and I guess that's why we do what we do, so you can know what's relevant at what time. And right now, this chart that we're looking at, I created it, but it is one of my favorites, is one of the keys to trend following, whether they be technical trends or seasonal trends or what have you. When the current market, the current trading is tracking the trend closely, as you can see in this image, they are, and it continues to do so. It just keeps reinforcing the continuation of the cycle. It's like inertia, so to speak, until it gets broken. So what we have here is the 4-year presidential election stock market cycle going back to 1949, and we go there sure you guys know, but the world changed after World War II, and 49 is the first full 4-year cycle since then. And then 21 through 23 here, which amazingly is moving much closer, quite closely to the pattern. You can see NASDAQ in this blue line, was below average in the big sell-off we had last year, but the trend is true. And what this tells us right now is I've got a few sideways arrows here that, we discussed a little bit of the sweet spot in the first segment and earlier this year that despite that sort of December, late year sell-off in, November, December sell-off in NASDAQ, and there was a little bit of a pullback down in the S&P, as you can see there towards the end of that chart. This sweet spot, the 3 quarters, midterm fourth quarter to pre-election year second quarter, really delivered, and above average gains. We discussed, NASDAQ up, 37%, the NDX, the Q's up 45 or 6, the Dow and the S&P right on a point about 20%. I think the Dow's a little bit lagging that average, as you can see the red line sort of below, but the Dow caught up, the last couple of months a bit, as there was some rotation into industrials and such. But what this tells us is that we've hit that mid-July peak of the pre-election year, which the next 2 charts you'll see even more clearly, and that shows the little August sell-off that we're beginning to accompany. I guess it's most pronounced in the dotted blue line of NASDAQ up there. A little bit of a rally from the end of August, like we discussed last segment, into mid-December. Then it sells off again. End of third quarter, Arusha, you'll attest, is usually quite volatile and to the downside. For fund managers, all you guys that run institutional money are what creates this pattern. This is a institutional money manager driven market, and these patterns are based on that. Learned that from Yale years ago. Some of it has to do with just window dressing and portfolio adjustments getting ahead of Q4. Some of it has to do with the October 31st deadline for the IRS from the 40 Act requirements for the accounting adjustments or reconciliation that has to happen every year. Some of it's a little self-fulfilling, like the October phobia, but you see that transpire at Q3, end of Q3, and that's why September is now the worst month of the year and has been for a while. And then the good news is the fourth quarter, the rally resumes, as it is likely to, as it has historically. I can see us hitting new highs, like all-time highs around year end. There's another thing that we have in the Almanac. It's actually in the current edition, the 50% move from the midterm low to the pre-election year high. And when I present that, I probably did it with you guys before. The sort of, it's about 48% on Dow and about 68 NASDAQ. That midterm low, so like October, December, whatever that low is, to the pre-election year high could be on average, 60-70% for NASDAQ. I mean, it's got quite a trajectory heading that direction already. But the other thing that I always found amazing is that most of those pre-election year highs, or the biggest cluster, transpires in December, and a lot of them on that last trading day of the year. So be prepared for this sideways chop and flop, pullback correction, nothing sinister, probably 5 to 10%. Probably get a couple of touches of that, but and then when everyone starts to throw in the towel, it's not just a correction, and the buy the tip crowd quiets down, we'll probably be ready to rally Q4, maybe another October turn. Wouldn't surprise me.
With all the data that you've collected, and again, where you're at in the presidential cycle is one very important piece of information, but a lot of attention, of course, right now is on where are we in an economic cycle? Are we, looking at recession? There's the soft landing crowd, and versus hard landing crowd, and maybe a no recession. And now, are there too many people saying no recession that we're definitely going to have a recession? So, where do you ever look at things in terms of that economic cycle versus the
Yes.
presidential cycle? Yeah. So what do
Yeah, I mean, I'll tell you, we will have a recession at some point in the future.
Okay.
We've had them in the past. We'll have another one again. I don't
Uh-huh.
foresee one here. I'm not an economist, but I believe the old definitions of 2 negative quarters of GDP back to back are a recession. We had those in 22. For some reason, they decided to change those rules during COVID. The rest of the world still abides by them. I still contend that we had a recession. Whatever the NBER says is their business. I've got some thoughts on the Fed and the yield curve as well. Everyone is still keen that the yield curve inversion means there will be a recession at some point. I think we're way at the far end. Arusha, you guys, and Jeff, you could probably help me here, are way at the far stretches of how long after the inversion starts that you get a recession that's ever happened before.
I feel like 18 months is the typical, and
18
we're there.
We're there.
Yeah.
So we look back, and my wonderful business partner and director of research, Chris Mistel, did some digging for us back into the minutes in the old days of the FOMC meetings back in '81, when remember it was like, oh, this is the worst inversion since '81, or it was. So we went back there, and in that meeting, and I've quoted in my service, the newsletter, there was a line from then Fed Chairman, the illustrious Paul Volcker, who said, I'm going to botch the quote, but basically, if the bond market, fluctuates outside of this range of 15 to 21%, okay, not 5, but 15 to 21%.
Yeah.
We'll adjust our rates at the next meeting or at a meeting. So they were listening to the bond market. Nowadays, the Fed is trying to lead the bond market. Therefore, I don't think the yield curve inversion has the same kind of impact at this juncture, considering what the Fed has tried to do and is doing. So I don't think there's a recession on the horizon. I think that those that were calling for it are on notice and have been for a while. Nobody was ready to believe that we hit a bottom last October. We had a rolling bear market bottom. We had, new lows hitting, hitting their peak in June. We had the Dow bottoming in September, the S&P bottoming in October, the Nasdaq bottoming in December. You had different, rolling recessions in different sectors and earnings, and it just didn't line up so perfectly for everyone. A little hindsight we have, it looks like it wasn't so crazy that there wasn't enough capitulation. But so no, I don't see a recession on the horizon. I looked at the GDP Now numbers, the Atlanta Fed GDP Now, which is really accurate. I know it's early and it can change, but it was like 4.1% using yesterday's numbers. I think that's probably what spooked the market a bit, because we're still expanding. The Fed's having trouble, containing expanding and consumption. So I suspect that we're going to get and tomorrow is CPI, right? I mean, can we talk about tomorrow?
Sure. Yeah.
Market sold off today. I didn't give you this chart, but we did. Again, this is some of Chris's great work too. We did a CPI projection that if the month over month is anything above 0 for this month, it's the CPI 12 month is going to tick up, and if it stays above 2% month over month moving forward, there's no way it's going to go down. So there's going to be a little bit of inflation scare, and it might transpire tomorrow. I think we had a pretty late day sell off. I was looking away at something else. It looked like that. I'm sure there's some whispers out there that CPI might be there. I put it out on Twitter. what we had discussed this about 3 or 4 weeks ago in the newsletter. So just because the economy is great and inflation ticks up, it doesn't mean it means there's probably not a recession, but it means the market's probably going to have a reason to correct here into these weak months. And we've come a long way. I mean, there's a lot of things adding up here. And we don't just look at the seasonals. We're looking at fundamentals, monetary policy, technicals, and sentiment. And sentiment, another thing, also got really bullish. I like Investors Intelligence. It was up at, the highest level since November 21, about 57% bulls. I'm in there. I'm in the correction camp, as we have been. And, it's just not super high bull market top, but definitely, intermediate correction, level of sentiment.
Mm-hmm. Yeah.
Yeah. Regarding like the recession, one thing I heard that, really kind of made sense is it's hard to have a recession when everyone still has jobs. And, which is like, oh, okay.
Yeah. Then there's that.
Yeah.
Exactly.
And I think that was the big thing about, you had this last recession, because of the back-to-back GDP numbers. The labor market was so strong. It was, kind of like, well, is this different because the labor market, the unemployment rate is 3.6 or whatever it was, is that really a recession?
Right.
It can't be.
Yeah, right. When
I totally glazed over that. You guys are 100% right. And that was something we're talking about all along the way.
Yeah.
You can't have a recession with a strong labor market.
Mm-hmm.
And they said the rates were going to, there was all that talk about higher rates are going to lose, was that Yellen that said that? Or somebody was saying that, that this is going to be unemployment is going to skyrocket because of cutting back.
Right. And that was like 6 months ago, right? Where a number of tech companies and other bigger companies were starting to cut. And
but remember what they ramped up during COVID to like unrealistic numbers of employment?
Right. That's true.
And then there's the fact that, when you've got these higher rates, there's a lot of passive income that gets increased.
Yeah.
Yes.
That flows into the market.
Mm-hmm.
People are making more money on their interest stuff. And a lot of people have these, low interest rate loans on things that aren't changing.
Yep.
Right.
Mm-hmm. Yeah, I'm not moving anytime soon. It's hard to get rid of a 2 3/4 rate, So, two more charts to go through. Let's take a look, kind of a zoom in of this particular third year in our cycle. So you've got the S&P 500 pre-election year chart that you gave us, and this is the S&P 500 that we can start with. Again, it kind of. You've already talked about it, but you can just anything else to kind of add with this chart. And just as a reminder for folks, if you're listening to this on the audio, these charts, you can find them on investors.com/podcast to watch the video version. I think, Jeff, you said that you tweeted out a number of these charts as well. You can find
Hirsch, for sure.
At Almanac Trader on Twitter or X or whatever you'd like to call it now. But yeah, go ahead.
Yeah, we'll have to figure out what to call it.
Yeah, right. I'll still go with Twitter for now. While it still uses twitter.com, I'll still, refer to it that way. But
for the record, I'm okay with the X. I don't have a problem.
I don't care either.
I'm just gonna go.
It works. Everyone's talking on there. Like, I know the little bird.
Yeah,
I missed the little bird though.
I mean, either way.
Yeah.
As long as it works.
Anyway, what are we looking at here?
The thing other than the midterm, other than the pre-election year, I have the word midterm here. I'll explain that in a second. But is the red line is my aggregate cycle, which it combines all years since 49, all pre-election years since 49, and then all third years of the decade, the decennial cycle. So that's what that is. A lot flatter because of the different factors that are averaged in there. The green line is this pre-election year after a midterm bear market. Not a lot of people were willing to, say it out loud that we had a midterm bear market, but we did. And you can see that the pre-election year is much stronger after midterm bear. And then the first term in the blue line kind of tracks that midterm bear year. That's, a first term president, which the whole driving force of the 4-year cycle is how the government manipulates the economy to stay in power. And that's a page in the upcoming book where it shows all these things that presidents and incumbent administrations or incumbent parties do to juice the economy and make the populace happy. And there's all sorts of things that been done with money coming out there. I think this year, which I wrote about in the book, the 24 book coming out, the negotiation around the debt ceiling, which I had spoken about, and we weren't expecting to be as bad because we'd already seen the movie before. And Biden, the consummate politician, whatever you think his mental capacity is, or whatever your political, leanings are, the guy's been around the block, been around the Pennsylvania Avenue for several decades. Not quite as long as the Almanac, but pretty long.
But up there.
But he knows his way around, and they built enough of a team around him that they, and he worked with the other side, with McCarthy, and he basically, put the kibosh on any more debt ceiling issues, and also didn't turn off the spigot on all the spending. So that was kind of a typical pre-election, priming the pump, how the government manipulates the economy type of move. And that's why we have this 4-year cycle, because there's no other country on the planet that has regular elections like we do. There's votes of no confidence. Look at Israel, the UK. I mean, I don't know what they call an election over there in China, but it's not really. It's a cycle I've been thinking about looking at, because of when they have the Communist Party thing. But that's another story. So here we have back to 2023 in the purple line, above the averages, but the trend is there. The trend is there. There's your March sell-off that we spoke about before. And here we are in this sort of mid-July peak. It rolled a little bit longer. You're going to see it more pronounced on the NASDAQ one there. But basically sideways, maybe a little bit of rally here off this low. It's not guaranteed. Pre-election year shows it a bit more, but we get the CPI tick up. Here's some other disappointments. The Fed starts, hawkish rhetoric again because of whatever happens. We may not get that rally, but again, the arrow says it all. Likely to chop along sideways until we get through October.
And if we look at the NASDAQ, kind of, the data for the NASDAQ, one thing I'm just wondering, because the NASDAQ got so far ahead of the typical. Again, I think, as you mentioned, the NASDAQ was up like 45% year to date at its peak. Is there ever anything where, if it gets a little bit overheated, the trend gets a little bit more, I guess, beyond its norm? That
I'm not sure. Yeah, I'm not sure it correlates. Just because you have more amplitude on the upside, that you're going to get more on the downside. Again, there's a momentum thing, and gains tend to beget gains. So I wouldn't necessarily suspect, just because it went up so much more than average, that it's going to come down so much more than average. That's not causal. But because it's tracking this, and trend is more important than level in all these types of things here. And what we're seeing is really quite a typical. I'm actually drawing a line here with my mouse, but you can't see mine. The July peak, right on the edge of this yellow frame that I put there, we sort of hit that right up here in the purple line as well. You see the red arrow I drew there. Yeah, we bounced again at the end of the month, but we're heading into this sideways situation. I have to check myself that it's going to continue tracking so closely. I mean, thankfully it's been much bigger, so it's not exact.
Right. Well, and if you're not going to be exact, it's always great to have it be more gains. No one's going to get mad at you for that. Oh, you were wrong.
Right.
But it also speaks to your earlier point that your concern was that you weren't bullish enough.
Yes.
When the year started. So
no, we did have our MACD sell signal for the best 8 months of NASDAQ towards the end of June, right here in that late sell-off. So we don't claim to pick tops and bottoms, but we try to get the big chunk of the trend. So
yeah.
And Jeff, I do remember back, it was like during May where it was in one of your updates where you talked about the sell in May go away, and you mentioned in the NASDAQ it's actually till the end of June.
yeah.
So I clearly remember that in May. I was like, oh, that's really interesting. Like S&P was end of May, but NASDAQ actually goes through the end of June.
And NASDAQ and all the techs are starting to influence the rest of the market a little bit. You see S&P
Yeah.
pushing a little bit further and everything else too. So it may be shifting.
Yeah. Very good. Well, when we come back, we're going to end this particular podcast with a look at some of the sectors and stocks that are on Jeffrey Hirsch's radar and why. So stay tuned. We'll be right back.
Trading Tesla? Sometimes you get the bear. Sometimes it gets you. Single stock daily leveraged and inverse ETFs from Direction. Before investing, carefully consider a fund's objectives, risk, charges, and expenses contained in the prospectus at Direction.com. Read carefully.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Piras, who is a portfolio manager at O'Neill Global Advisors, and he joins us every week, which is just awesome. He couldn't let go of that podcast. He was our original host, but still wanted to join us every week, which I'm very grateful for. And then another guest that I'm just grateful for because he's becoming a regular, Jeffrey Hirsch, giving us all this information that he's compiled, that his dad started compiling and that he's continued compiling for the Stock Traders Almanac. He, of course, is the editor-in-chief over there, doing constant updates. Also, a good follow on Twitter at Almanac Trader. So, Jeffrey, let's talk a little bit about the sectors now. What sectors, we talked a little bit about the economic cycle, but are there sectors that you're looking at having maybe an edge right now, or is this more a matter of, okay, you've got great gains for the year, just don't give them up?
Well, we're seasonal people. We have a seasonal switching strategy, the tactical strategy. Best and worst months. NASDAQ is best 8 months, worst 4 months. It goes from November to June. Everyone knows about sell in May and go away. I like to say buy in October and get yourself sober, just for something that might rhyme. But the thing is, you can't sell in May if you didn't buy in October, like we did. And, we use some technical analysis to pick those buy limits. We start looking for getting into the best 6 months, which is something that Yale came up with, created back in '86. We start looking for the best months in October. Starting after October 1, we look for MACD crossovers in all three, the Dow, S&P, and NASDAQ. We use a slightly different one. We use the 817.9 for the buy side, which is shorter, faster. Bottoms are more of a process that allows you to get in when it turns, which a little bit early this year. We got in October 3rd or 4th of that early last year with that early October pop. But and then April for the Dow and S&P, we start looking for the 1226.9 crossover for the sell. And then June, which I was just saying that we had our sell signal, MACD sell signal in June of for NASDAQ. I think it was the 23rd, if memory serves, when that happened. But what you were showing before is, for the first time in several years, coming off of, what is it, a decade or so of ZIRP, where we had, zero interest rate policy. There was no place to park cash when you were on the sidelines to earn anything. And now we've got short-term rates up to 5%. So our two favorites right now for the worst months, and I own them, are SHV and SGOV, the two short-term bond ETFs. The chart is, just showing the different dividend payment and the chop there. But basically, and one of the things, the questions that we got in our own, members webinar was about the yield, and people, you see the yields on whether it's, any of the brokerage firms or websites. It shows the annual yield, which is an average of what's happened over the year. Last year, this time rates were nowhere.
Yeah. So
you have to go to the issuer's website, the iShares site. When you go look at the stats, you click on, it's something called the SEC yield. It shows you like the 7-day yield, which is upwards of 5% for these two. So, You know, cash gives you time to think. It's a position. We're in it. A lot of our tactical portfolio, or all of it, is in the bond position. Some of them it's in money market. So it's great to be able to have a bit of return while we, you know, mine the summer doldrums and the August-September weakness and the different data points that are going to be coming out economically, and also the window dressing that Arusha will be participating in next month.
Spearheading.
Yeah, Jeff, it is interesting because it's been a long time since stocks had an actual alternative option, right?
Right. Yeah.
Just staying in cash and earning that 5%. It's like, why do I need to bother with the volatility in the stock market when I can just keep getting that 5%? So
a stable alternative. There's been
Yes.
there's a lot of talk about alternative investments for quite a while, but this is like, you know, the U.S. government. I mean, we might have a lot of debt, but they're going to pay this bond for the next few months.
Yeah, and even with a downgrade of the debt, you know, it's still considered risk-free. You know, I mean, that's your risk-free rate. You know, so now, so are there other areas that you're looking at? Well, first of all, let me say, you were kind of mentioning how, you know, you've been looking at the market and everything like that. So is your participation more using ETFs like the Qs, the spiders, the diamonds, or do you kind of use that backdrop of, okay, here's what the expectation for the market is. Now I'm going to look for, you know, a top-down approach. The market should do this. These sectors are where it might be at, and these are the stocks that I'm going to look at. Or
we have three sort of, you know, buckets. One is the seasonal switching strategy tactics for the broad market, Dow, S&P, NASDAQ, Russell, which is what we just spoke about. Then we have sector seasonality, where each sector has their own seasonality. Newsflash, shocker, most of the sectors come into the bullish season around October through, you know, April, May, June. We use technicals as well as, you know, tracking that seasonal trend and whatever other fundamental stories are going on there, or events or developments, to trade and invest in the sector rotation strategy, which has a few things coming around, both long and short, on the calendar. Then the third thing, which we'll touch on, I think, a little bit later, just briefly, is the stock selection process. We use a robust fundamental screen. I've talked about it before with you guys. I kind of think of it as pre-canned slim. We're looking for a lot of, you know, acceleration of growth in revenue and earnings, great valuations, price to sales, price to earnings, and underfollowed stocks by analysts. But we do that at certain times of the year when the historic seasonality is set up. And I don't necessarily have a sector screen on that. We let sort of the fundamental stock screen show us. It's kind of a bottom-up sort of approach.
Okay.
With the seasonal overlay. So I let the screen itself show us what sectors are doing well, and throwing off, you know, good corporate quarterly numbers and sequential year-over-year numbers as well.
Any sectors popping up right now outside of the bonds? And you also mentioned, you know, some shorting potential opportunities.
So the sectors on the rotation calendar right now that are coming into play are biotech and technology. Because of how far things have come and what's been going on, we're looking to get into these on, you know, pullbacks at the IYW you got there. Yeah, that's something we're looking to dip below the market. It's down in the last, you know, couple of weeks and more today, but it's not quite at our level of a buy yet. I don't know. You guys are technicians as well. You could probably see where we might want to buy this if it gets down there. There's some sort of gap in there. Yeah, maybe somewhere in that area. Maybe not quite that low, but yeah, around there.
Yeah.
So, and then the biotech, the XBI and the IBD, which are some of my favorite sectors long term because of just the aging of society and the future of you know, the planet probably has a lot to do with how we do. again, those are also something that we're looking at lower prices. This sector hasn't done all that great. I owned it for a while myself. I sold out a while back. I think it was at the end of the best 6 months. I got out of my XBI position, but I'll be looking to get back into this. What's that level down there in your chart? 120 something looks
120s,
like.
yeah, 120.72.
Yeah, that's probably in the vicinity of where it might be attractive. We've got specific buy limits in the newsletter. One of the things that we pride ourselves on is not just telling people what to buy, but when to buy and at what price and when to sell and where we're looking at it. We constantly raising our stops and, letting winners ride and selling losers short. Just your basic, portfolio management and investment, management techniques. And then there's a couple of shorts that we have out there. Again, we're looking to get into these on breakdowns below support. The transports and the industrials, the IYT and the XLI are a couple that we have been looking to get into for a little while. It's they haven't quite hit our levels yet. You could probably see where we want to break through at the industrials, but you want to see it break some support, whatever support level you might like there. We're already through. Is that's the 50-day in pink?
Yeah, right here it's a 50-day, and this is the trend, and this is the transports too.
Is that the 200-day in the red line?
No, this is the red line's the 50-day,
and
the 200 is the black line.
200 is the black line. Yes.
Okay. Yeah. So 50 days are decent areas. Is that a big cup, right?
Yeah. I mean, this one, in my opinion, looks pretty bullish still. Now, of course, if it were to break the 50-day or definitely the 200-day, then I'm all in.
I would concur that it looks pretty bullish. We had a little Dow theory, confirmation a few weeks back, if I remember seeing it going around there. So we had a new high in the transport, confirming a high in the industrials, which is great. So that's why we're not shorting this unless it breaks down through support. And if it doesn't, we pass,
Right.
And we can keep our money at 5% until we get into the best months. And then we go long for the end of the pre-election year.
What about the semiconductors?
Yeah, the stocks. I was just going to go there. Again, there's a tendency for stocks to sell off August through October.
That's interesting.
Just one of those. It's right out of the Almanac. One of those sectors that we tracked is that it's an average of 7.7% decline over the past 25 years from mid-August to the end of October.
Wow. So so you're saying, or the Almanac's saying that maybe Nvidia is not going to report well in a couple of weeks.
Well, this goes into one of the stocks we talked about as well. So there's been a lot of AI fueled rallying in the semiconductors and generally the market and the technology especially. But there's been some sort of a lack of demand in consumer semiconductors and laptops and PCs and that sort of stuff. But now we've got some disappointments from Nvidia. I think it was Qualcomm a little while back, and some other of the semiconductor stocks. And then the big one that we picked back in November at significantly lower prices was Super Microcomputer, down 20. It was down about 25% at the lowest today. Looks like it closed off the lows, just abyssal. But we're in it from back around 82, 81.93 back on November 10th, and this is one of the ones that came through our fundamental screens. So we're still up a couple 100%. We sold half on a double already, around 164, whatever it was. And our stop is well below the market right now, probably in that in between the what is that, the June peak and the June low, somewhere in there is where our stop is. Probably a little higher than that, but we might adjust it. We get stopped out. It looks like it's trying to find some support around. That's the 50-day again in the red line?
Yeah. So right now it's like almost 2% under the 50-day.
It's going to need to find some support quickly.
Yes.
It may not. It whatever support that was there at the June high is under pressure. There's another gap way below there. I'm not so sure. I looked at the news here, and it's, their numbers for this current quarter, Q4, whatever it was, were great, but their outlook for 24 wasn't so much above the consensus estimates or the analyst estimates. So, things are slowing down a little bit. I think the AI, chip craze has sort of gotten ahead of itself in the stocks. So again, if this, the semiconductor short is what we were talking about initially, if we break down a little bit further, I think we could short that, but we're not going to get out of super micro unless it goes to our stop, and we'll still have, we've still logged some sizable gains on that, and it just proves that the system, and there's not a whole lot of stocks left from what we picked last year, and on our best months baskets, because if they don't go up or they come down to it's not always the 7 or 8% that you guys use, but it'll be a little bit more for the smaller cap ones, because of their standard deviation and such. But you trim the losers, you let the winners ride, and you keep rolling whatever you sold, whatever cash left, into your next best ideas, whether it's the sectors, the best months, or other stocks. Or now we can just hang on to some cash,
Right,
and
exactly.
look for better buys, look for better ideas.
Yeah. Wait for the fat pitch, as we like to say. So
Precisely.
yeah. Well, hey, Jeffrey Hirsch, it's always a pleasure having you on the show. We were making you a regular in January. Maybe we're going to have to do an even more regular touch base with you. Always great stuff. And thanks a lot for showing up and sharing all of your data. And just as a reminder for folks, at Almanac Trader is where you can find Jeffrey Hirsch on Twitter. You can also go to Stock Traders Almanac. That's where you can get your own almanac and subscription to his service. So again, thanks a lot for showing up.
Hey man, I would love to be a regular. I enjoy our time together. I always learn a lot, and thanks again for having me. Enjoy your
Absolutely.
summers.
Yeah, you too. So that's going to wrap it up for us this week. Next week, we're going to have Jim Ropel on. So we'll kind of find out how he's handling things. I know SMCI has been on his radar. He's been kind of the Super Bowl. We'll see how he's handling the correction. I'm going to be in Hawaii, so I'm going to be doing the podcast from there with my arm up again. But we should have a great show. It's going to be great to have the ropes on. So hope you join us for that. We'll see you next time. Take care.